China dumped $69 billion in US Treasuries in one quarter, the biggest single-quarter sell-off since 2016. This wasn't portfolio rebalancing. This was the systematic dismantling of dollar plumbing. Treasury market liquidity is collapsing, bid-ask spreads widening, depth evaporating. The VIX spiked, repo rates breaking, margin calls spreading across the system like wildfire. The math was always going to force this moment, and we're watching the liquidity crisis unfold in real time. The beast is bleeding, and the banks have no defense. China's Treasury holdings dropped from $859 billion in May 2024 to $759 billion by December. $100 billion vanished in 7 months. But the real damage isn't in the headline number. The real damage is in the secondary effects. When the biggest buyer becomes a seller, market depth collapses. The Treasury market operates on leverage. Dealers finance their inventory through repo markets. They borrow short-term cash, post Treasuries as collateral, and hold the bonds until they find a buyer. This system works when markets are liquid, when buyers and sellers are balanced, when spreads are tight and transactions flow smoothly. China's sell-off broke that balance. When China sells, dealers must absorb the inventory. They have no choice. They're the market makers. But absorbing inventory requires financing, more repo financing. And when everyone needs repo financing at the same time, rates spike. Repo rate spikes force margin calls across the system. Hedge funds leveraged 10 to 1 suddenly need cash. Pension funds holding treasuries as collateral face haircuts. Banks financing dealer operations demand higher rates. The entire interconnected web of leverage starts pulling itself apart. The VIX hit 52 on April 8th. Markets don't price in fear like that unless they're detecting a liquidity event that can't be fixed with rate cuts. This is identical to the September 2019 repo crisis, except now there's no Fed backstop without triggering inflation. In 2019, the Fed injected $120 billion overnight to stabilize repo markets. They restarted QE in everything but name, but that was when inflation was dormant, when the Fed had room to expand the balance sheet without consequences. Today, inflation is the constraint. The Fed can't inject liquidity without destroying credibility, without admitting they have lost control of prices, without triggering the exact currency collapse they're trying to prevent. China knows this. They built the alternative infrastructure while the US was distracted. CIPS, the cross-border interbank payment system, launched in 2015, now includes 168 direct participants spanning every major region. This isn't theory, this is operational infrastructure. Processing real transactions outside the dollar system. Currency swap agreements with 42 countries, totaling $3.8 trillion in capacity. Bilateral trade settled in yuan. Energy purchases denominated in yuan. Commodity contracts priced in yuan. China isn't attacking the dollar. China is executing the exit while building the replacement. They're selling treasuries, accumulating gold, expanding CEPs, signing swap agreements. Every single action is preparation for the dollar losing reserve status. The liquidity crisis isn't coming. It's here. And the math guarantees it accelerates. Here's why. The Treasury market is $26 trillion. Foreign holders own $8.5 trillion of that. China just cut their holdings by $100 billion. Japan, the biggest holder at $13 trillion, is also trimming. They cut holdings in 2024. The UK cut holdings. Saudi Arabia cut holdings. When the biggest buyers become sellers, who absorbs the supply? The Fed can't, not without restarting QE and triggering inflation. Primary dealers can't. They're already stretched financing existing inventory. Domestic buyers can't absorb $8.5 trillion in selling pressure. The math doesn't work. This creates a positive feedback loop from hell. China sells. Dealers absorb inventory. Repo rates spike. Margin calls spread. Leveraged funds liquidate positions. More treasuries hit the market. Dealers need more financing. Repo rates spike higher. The cycle feeds on itself. The Treasury market is the foundation of the entire financial system. It's the collateral for repo markets, the benchmark for corporate bonds, the safe asset in pension portfolios, the reserve asset for foreign central banks. When Treasury market liquidity collapses, everything built on top of it collapses too. Corporate bond markets freeze, mortgage-backed securities seize, municipal debt markets lock up, the entire credit system stops functioning. This is mathematical certainty, not prediction. The numbers prove it. China triggered the crisis by recognizing the system was already broken. They're just the first to act on it. The US runs $2 trillion deficits annually. That's 7% of GDP. Every single year, the government must borrow $2 trillion to cover spending. It can't fund through taxes. And that borrowing requires constant foreign financing. Foreign holders own $8.5 trillion in treasuries. But who's buying when China's selling? This is the trap. The US needs foreign buyers to finance deficits. But foreign buyers are becoming sellers. Japan trimmed holdings in 2024. The UK reduced positions. Saudi Arabia cut exposure. The exodus has started. The Fed faces an impossible choice. They can step in and buy treasuries, restart QE, inject liquidity into the system, but that triggers inflation. It destroys credibility. It admits they've lost control, and it accelerates the exact currency collapse they're trying to prevent, where they can raise rates to attract buyers, make treasuries more appealing, pull capital back into dollar assets. But raising rates crushes the economy. It makes the deficit worse through higher interest payments. And it exposes every over-leveraged position in the system. There is no third option. Every defense mechanism either accelerates inflation or triggers financial collapse. Capital controls are the nuclear option. Restrict dollar outflows. Force foreign holders to keep their treasuries. Trap capital inside the system. But capital controls signal panic. They prove the system is breaking, and they accelerate the exodus they're designed to prevent. History proves this. Britain tried capital controls in 1947. They failed. Nixon tried closing the gold window in 1971. It failed. Germany tried printing their way out in 1923. It destroyed the currency. The pattern repeats because the math is identical. When external obligations exceed your ability to pay, when confidence evaporates, when alternative systems get built, the old order dies. No amount of intervention changes the outcome. The repo market seized up in September 2019 with $120 billion in Fed intervention. That crisis was contained. This crisis is 10 times larger. The sell-off is bigger, the leverage is higher, the interconnections are deeper, and the Fed has no room to maneuver. Banks are sitting on $620 billion in unrealized losses from rising rates. These losses are hidden on balance sheets because banks hold treasuries to maturity. They don't mark to market. They pretend the losses don't exist. But liquidity stress exposes this. When banks need cash, they must sell treasuries. And selling treasuries at current market prices crystallizes those losses. It turns unrealized losses into real capital destruction. The FDIC insurance fund is $128 billion. It covers $23 trillion in deposits. That's a 0.5% coverage ratio. One liquidity run breaks the system, one major bank failure depletes the fund, and the cascade begins. Silicon Valley Bank failed in March 2023 with $209 billion in assets. The FDIC covered deposits, but that was one bank. What happens when 10 banks fail? 20? 50? The system has no defense because the system was built on assumptions that no longer hold. The assumption that foreign buyers would always absorb treasury issuance. The assumption that the Fed could always inject liquidity without consequences. The assumption that the dollar would remain the reserve currency forever. Those assumptions are breaking. China knows this. They're forcing the US to choose between currency collapse and financial system failure. And there is no choice that preserves both. Every defense mechanism fails because the underlying math is broken. $8.5 trillion in foreign claims against a system running $2 trillion deficits. A Fed balance sheet at $7 trillion with inflation still elevated. Banks holding $620 billion in unrealized losses. A deposit insurance fund covering 0.5% of deposits. The numbers don't work. The defenses don't exist. And China just lit the fuse. Stage 1, Treasury yields spike as buyers disappear. The 10-year breaks 5%. The 30-year hits 6%. These aren't just numbers on a screen. These are the interest rates the government pays to borrow money. And when rates spike, the cost of servicing the debt explodes. Every percentage point increase in rates adds $330 billion to annual interest payments. At 6%, the US is paying nearly $2 trillion per year just on interest. That's the entire deficit. The government is borrowing money just to pay interest on money it already borrowed. This is the debt spiral, and it's already begun. Stage 2, margin calls ripple through the system. Hedge funds leveraged 10-to-1 face liquidation. They borrowed $10 for every $1 of capital. When treasury prices fall, their collateral loses value. Prime brokers demand more cash. The funds have no choice but to sell. But selling into a falling market accelerates the decline. More selling drives prices lower. Lower prices trigger more margin calls. More margin calls force more selling. The feedback loop is mechanical, unstoppable. Pension funds holding treasuries as safe assets suddenly face losses. Corporate treasuries managing cash and government bonds watch their portfolios bleed. Insurance companies required to hold treasuries for regulatory capital see their balance sheets deteriorate. Stage 3, credit markets freeze. Corporate bonds, mortgage-backed securities, municipal debt, all of it seizes, because everything is priced off treasuries. When the treasury market breaks, the entire yield curve breaks with it. Companies that need to refinance debt can't, the market won't clear, buyers vanish, spreads blow out to levels that make borrowing impossible. Investment-grade companies suddenly can't access capital. Junk bonds become untouchable. Mortgage rates spike. The housing market freezes. Homeowners can't refinance. Buyers can't afford new purchases. Construction stops. The real economy grinds to a halt. Municipal governments funding infrastructure through bond issuance face a wall. Projects get canceled. Services get cut. The contagion spreads from financial markets into the real world. Stage 4, bank runs begin. Depositors panic. They see the news. They understand the math. They know the FDIC fund is $128 billion, covering $23 trillion in deposits. They know banks are holding $620 billion in unrealized losses. And they run. Silicon Valley Bank collapsed in 48 hours, from solvent to insolvent to seized by regulators in 2 days. That was one bank. What happens when 10 banks face runs simultaneously? 20, 50. The FDIC fund depletes. Emergency measures fail. The Fed injects liquidity, but it's not enough. Congress debates bailouts, but the political will doesn't exist. The system breaks. This pattern played out in Britain in 1947, in Nixon's America in 1971, in Weimar Germany in the 1920s. Every reserve currency collapse follows identical mechanics. The difference is speed. Modern markets move at algorithmic velocity. High-frequency trading, automated liquidations, instant information flow. What took Britain 30 years to collapse could take the US 30 days. Gold is already signaling the break. Central banks bought 1,037 tons in 2023, another 1,045 tons in 2024. They're not buying gold because they think it's a good investment. They're buying gold because they know the dollar system is ending. Silver industrial demand hit 654 million ounces in 2024. Physical markets are pricing in dollar failure while paper markets still pretend everything is fine. The smart money isn't waiting for official confirmation. They're moving now while exits still exist. Because once the cascade begins, the exits close. Capital controls lock in. Bank accounts freeze. The trap snaps shut. China triggered this by recognizing the math was already broken. They're just the first to act on it. The liquidity crisis is mathematical certainty. $8.5 trillion in foreign claims against a system running $2 trillion deficits. China's sell-off is the match, but the kindling was decades of monetary expansion without real backing. When the biggest buyer becomes the biggest seller, liquidity evaporates and the cascade begins. History shows no reserve currency in this stage has ever reversed course. The pattern completes every time. Position accordingly. This isn't prediction. This is pattern recognition of a system already in collapse.